All right, so part two. Let's talk about COVID. COVID was the beginning of my trading experience. It's where I started. It's where I started to educate myself. It's where I started to meet a ton of awesome personalities and people on FinTwit, on Reddit, all these different sub-communities, Discord, etc. This is where it all began. And it was such a big deal because having the ability to have apps on a phone where you could trade derivatives, specifically options, is a huge technological leap. You know, back in 2001, if you wanted to buy an option, you had to call a broker, and they didn't have any type of, zero DTE trades or like weekly expirations. Like, you were buying quarterlies and monthlies with the institutions. And now you got Robinhood, Fidelity, Schwab, TD, right? It's never ending with these apps. Webull, and you can trade like zero DTE options. And what they're doing is turning the market into a complete casino. I think 50% now of the market is zero DTE trades on the options volume. That is absolutely mind-blowing. And with zero DTEs come wide spreads, comes crazy amounts of theta decay, comes a lot of slippage, and a lot of intraday fees from the brokers. Payment for order flow is a thing. Brokers are being paid by market makers to send their orders to them, like Citadel, Virtue. It changed the game a lot. And it really turned what people thought was a fair market into an absolute money-making machine. And I think that's basically the biggest reason why people were brought together in these large communities, because everyone was kind of trying to understand the fastest way to beat the system. Now, let's talk about COVID. COVID 2020. The market crashes, okay? This was a big one. It was 35%. And let's take some quick fibs here from the 2008 retracement. I believe that was 21% of the time. This was because of the United States and China trade war that was going on. There was a lot of uncertainty in the market. Interest rates began to rise during that time, and equities took a hit. So let's take fibs real quick. Swing from high to low, 2018, and you get your COVID top right at the 1618. Like, bang, on the money, to the penny. If you didn't know where the blow off top was going to be, you could have measured before and you would have got that. Also, quick speed line, just so you guys can see it as Confluence running up from 2016, just an absolute demand support speed line. Usually when you take speed lines, you want to measure through like the middle of the liquidity zone, depending on which direction you're going in, if it's diagonal, horizontal, vertical, whatever. The middle of the liquidity zone is what the algorithms respect the most. Remember, the vehicles that control high frequency trading, algorithms that control the stock market, they're based off volume liquidity, and the volume shelves, the VRVP levels, are what get built on the right side of the screen, as you guys can see, and we'll talk about that more as I go through the documentary real quick as well. Fib Bollinger Bands, let me just pop these in real quick, right at the top. Right, so that's your one on your Fib Bollinger Band. So just all different technical areas of Confluence that would have led you to see where the blow off top was going to be, even if you didn't really understand what was going on leading up into the weeks prior. Now, during this crash, the bond market demand explodes because the bond market and U.S. Treasuries are a hedge for the equity market when it falls. Institutions flock to the bond market, demand rises, prices go up. So during this period in time, I think something that people didn't really understand was hedge funds took out a massive $600 billion short position. And they did this because they knew Powell was going to make interest rates zero, making the bond demand completely decline over the next few years. And what this did over the next 3 years was drive the bond market price-wise into an absolute hole. Hedge funds were over-leveraged at that time. I mean, before COVID, I think they were allowed to be over leveraged, like 170 to 1. And then after COVID, I believe they tightened the margin restrictions, and it was down to like 120, and eventually got down to 90. But still, just a ridiculous amount of overexposure, which just like starts to rhyme with 2008 in so many ways, shapes and forms. You combine this short position on the bond futures market with the debt ceiling being raised and QT happening in 2 years' time from now, which I will get to later in the documentary. And this is why you get your extreme bond price declines over the next 3 years. So the equity market is now at a major macro low. And what does Powell do? He starts quantitative easing. And the last time quantitative easing happened was in between 2008 and 2014. And I'll cover that in a minute. I'll also cover what quantitative easing is in a minute. But just to start, QE is the fastest way to inject money into the system via buying various kinds of bonds. Now, normally this could have a positive effect on the market to stimulate growth, stimulate borrowing. But the problem is when you do it too much, it gets to a point where you start to really affect inflation. And what people have to remember that when COVID happened and the global economy shut down, trade routes are down, imports and exports are going nowhere. The commodity market got completely destroyed. Oil was negative pricing wise at that time. The fixed income market, now that Powell has made interest rates zero, makes the demand for bonds basically fall off a complete cliff. Right? So there is no other place to put your money. If you're a pension fund, an asset manager, an insurance firm, you have hundreds of billions of dollars assets under management and derivatives as well. Where are you going to put your money during this period in time? Powell makes interest rates zero. Right, the federal funds rate is 0 to 0.25. The repo rate goes to 0. Housing rates are at now incredible lows, so people are incentivized to borrow and take out mortgage on homes because they have low rates. Same thing that happened in 2001. Same thing that happened before the 2008 crash. And there's no other place for institutions to put their money except the equity market. You have a low repo rate, right? Federal Reserve requirements are low as well. They were all lowered. It's like it completely turns it into the Wild West of lending, which is an absolute frenzy for the equity market. You see the equity market move to new all-time highs, and that's when things get absolutely crazy. Now let's talk about the repo markets really quickly, because this is really important. We have to touch on this to understand, because all this money that is funneling into the equity market is going through the repo and reverse repo markets. What a repurchase agreement is basically an exchange of collateral for finances, which are agreed upon to be paid back at a later date for a higher amount. Now, a reverse repo is the exact opposite. It's the person that is giving the finances to the other institution. Usually, pretend you're a lender, right? And remember that the repo and reverse repo markets, they are like the pawn shop of the entire market. Right? If they don't exist, all this free-flowing liquidity transfers can't happen. And that's a big problem because they need things to keep moving just in case, a bank or an institution on the buy side gets in a sticky spot. Now, if you're on the opposite side, if you're doing a repurchase agreement, you need financing for some period of time, whether it's overnight or for a couple months, maybe even a year, depending on, how long you need that. That's the agreement that you have drawn up with the other institution on the opposite side. But the institution on the opposite side is giving you cash for a certain specific period of time. So the collateral that you give them has to be worth, a certain amount for that cash. You go to a pawn shop, you give them your chain, they give you $100, and they say, all right, this chain is worth, probably, $200 or $150, but we're going to give you $100 just in case. They give you less money than what the collateral is actually worth, because if something happens to you as the institutional the institutional borrower of the financing, if something happens to your collateral and it loses its value, then the person on the opposite side, the institution on the opposite side, is going to be in a bad hole. They're going to be holding your collateral, but it's going to be worth less. So this is where haircuts come into play. Any institution that is lending money to another institution, the collateral that they receive, and this could be anywhere from like bonds or any types of securities, asset-backed securities, equities. There's a lot of different loopholes and rules in the institutional world, things that can be lent out as collateral for financing for a specific period of time. But they want to make sure that their end is covered. So they do what is called a haircut. I've probably heard that on Twitter or in financial articles and things like that. It basically means like what I just said with the chain example. They give you less money than the collateral is worth, and that difference in the prices is called a haircut. So without the repo and reverse repo markets during this time functioning so fluidly. With low rates, federal funds rate comes down, the repo rates come down as well. You don't get this run in equities. And just to take a quick measurement from a TA perspective, I know it was over 100%, 120% on the index. And again, let's take our Fibonacci levels, swing top to bottom. You're 1786 to the penny. So just, the Fib levels are respected through every major macroeconomic macro move. And if you're leading into one of these events, just make sure you're taking your macro Fib so you can be prepared for, the different levels that they're going to respect in the future. That is life-changing money if you bought, option leaps on a move this big. So just so you guys understand that part. Now, to get back into QE, during the 2008 portion that happened between 08 and 2014, inflation levels were very different and the Fed's balance sheet was very different. Now, it's one thing to do QE back then because things were a little bit different. But now in this current time that we have, the money supply is already kind of extended. But back then, the Fed's balance sheet was a lot smaller. Before the 2008 housing bubble crisis, as you can see it on the chart, $900 billion in 2007. That's how large the Fed's balance sheet was. In comparison to now, where it's $9 trillion plus. But as you could see, 2008 expanded by double to make up for the lack of liquidity at the time because of the housing crash. And when QE started in 2008, it came in 3 different phases. Each phase was like 1.5 to 2 years, and it finished, I believe, in October 2014, where the balance sheet was then 4.5 trillion. So you get to this period where you have to think of it like if you have a balance sheet of any business, right? Any balance sheet that's like diluted to an extreme like this is going to cause issues in the underlying assets that they back. Now, a quick example in layman's terms for my smooth brains, pretend you're an apple farmer and you have 10 apples and each apple is worth $10. You now have $100 worth of supply. Now, say you add 90 more apples to that table, you now have 100 apples. Those apples are no longer worth $10 each. They're worth 10 times less. So that's what's going on with inflation. Every single time the Fed does another round of QE, they dilute the money supply. The more the money supply goes up, the less each United States dollar is worth. The inflation that is coming because the rampant inflation that we have right now, it's not something that they didn't know was going to happen. You know what I'm saying? You can't just pump $4 trillion into the system through the bond market and expect nothing to happen. And that's one of the narratives you see on television a lot. They talk about the Fed's stuck in between a rock and a hard place. Yeah, man, they put themselves there. You didn't need to pump $4 trillion into the market to save it from COVID. They could have slowly did it and built back the economy at a gradual pace and everything would have been fine, but that's not how the world works. This economy, once the Bretton Woods gold standard was abolished in the 70s, they supercharge this thing and they control the monetary supply. They control the price, they control the amount of dollars in circulation, they control it all. So now put that into context of why they want to enact the central bank digital currency so badly. They don't want any untraceable dollars. They don't want you having any cash under the mattress. They don't want money laundering. They don't want under the table deals between institutions, especially globally. One world government, one world currency. They want to be able to see everything. And just remember, if they can see all your finances and they're all electronic and not tangible, because you won't be able to take money out of the bank anymore, it won't exist. They don't have enough supply anymore because the dollar is so inflated and the banks are going to be consolidated after 2028. If you do something illegal, they can freeze your bank account like that. Now let's get back to the balance sheet. I want to cover those numbers really quick before QE started to become more aggressive and sent the stock market flying off of the COVID bottom. Also want to talk about the definition of what quantitative easing actually is and quantitative tightening. So let's go over the numbers real quick after COVID. So we had a balance sheet of 4.5 trillion in 2014. After COVID, 3.1 trillion by the end of the year. So that's 9 months, 3.1 trillion. Just bam, right? You had 224 billion in assets and different kinds of bonds. You had 80 billion in treasury securities, 40 billion in mortgage-backed securities every single month. That's insane. And then 2021, QE continues, another 1.4 trillion on the balance sheet expansion by the end of the year. And you get to the point right before the Fed started quantitative tightening, which happened in June. I believe the date was quantitative tightening, June 1st. So all the way out to May 2022, a total of basically $9 trillion on the balance sheet. So let's get into the definition of what quantitative easing is. Quantitative easing is the act of the Fed expanding its balance sheet by buying various types of bonds like government bonds, mortgage-backed securities, corporate bonds, asset-backed securities, and just in general, different types of U.S. treasuries, T-bills, T-notes, T-bonds as well with different maturities. So they are effectively removing all these different assets and bonds from the institutional system, and they're injecting cash and liquidity into the system. Now, what we said before, the commodity market, global economy shut down. The fixed income market, interest rates are zero. So the only place money could have went through the repo market is the equity market, which then spied to new all-time highs. But when I want you to think of like QE as just a massive liquidity injection into the equity markets at this point in time. And remember too, like government-backed bonds, securities, these are the most important assets in the world because they're backed by the United States government. And the US isn't going back to the Stone Ages anytime soon. It's one of the main reasons why China, Japan, they buy up a ton of our debt, right? So if you are let's say a pension fund or an insurance firm, you need to generate consistent returns in your portfolio that has different asset classes that you invest in over a long period of time, right? 50 years, 70 years, 100 years. You want something that's low risk and consistent reward. You don't want to invest in the equity markets all the time. If you could have a government-backed bond, I mean, it's like diamonds, right? It's the number one thing that you want. Now remember, during periods of QE, because the Fed is trying to expand their balance sheet so aggressively, the demand for bonds is higher, so the prices of bonds rises, but the yield of bonds decreases over time. And in layman's terms, just think about it. If the price of something that you're paying for is higher, the return or the yield that you are going to receive on that security over time is going to be less. And if you look at 2008, you could see the 10-year bond yield decreasing from 2008 to 2014 as QE was going on. And when you think of QT, it's the opposite. The Fed is reducing their balance sheet, putting bond supply back into the market. So all these institutions, the pension funds, the insurance firms, portfolio managers, asset managers, etc., they all want these bonds because of the reasons I just spoke about. During this time, because there is more supply going into the market, the bond prices are diluted, bond prices go down and they decline, the bond yields rise. When you hear quantitative easing, just kind of think that, there's a lot of cash being injected into the market via the transfer of bonds. And it's pretty straightforward in that sense. When QE is going on, bond yields drop. When QT is going on, bond yields rise. More supply in the market, the higher the bond yield is going to be, because the more supply there is, the more diluted the bond market is, the bond prices go down and yields rise. Now, during COVID, everything got turned on its head, and this is what's so important to understand about this fundamentally during this time. Now, like what I just said about QE during 2008 to 2014, bond yields consistently drop because bond demand is higher, the prices of bonds rise. However, there is no demand for bonds when interest rates are effectively zero after COVID, because interest rates being zero basically means bond yields are unattractive and no institution wants to invest in them. The demand for equities was so high during the bottom of COVID, and the demand for bonds was so low that the bond yields exploded off the bottom, as you can see, to attract new institutional investors. Now, this is like the most important part, and here's the kicker, because in 2008, after we had our financial banking collapse, QE went on during that time as well, and bond demand was higher during that time as well, but bond yields decreased. And why is that? Because plainly and simply, there was no extreme demand for equities. The banks fell. It was a banking crisis. COVID is not a banking crisis. Things were just shut down. The banks were fine. The money just flew into equities, and that huge demand for equities is why you see bond demand at all-time lows. So this period of having this massive influx of cash into the system, coupled with interest rates being effectively zero, just threw the bond market for this kind of opposite loop. Just because bond demand is high from the Fed standpoint of view, it's not high from an institutional standpoint of view because interest rates are zero and equity demand is at an all-time high. So in a usual period where bond demand is higher, bond prices rise, bond yields go down, which is what's supposed to be going on right now, and the normal way a quantitative easing period happens. There is no demand for bonds because of COVID. And couple that with the hedge fund $600 billion over-leveraged short bond futures positions, and you understand why bond demand is at an all-time low and yields are exploding off the bottom. And it's the first time we've really ever seen this. And it's what's so confusing to people on a day-to-day basis when understanding why bond yields are flying and continue to fly over the previous 3 years. Now, there's more reasons why they are, even doubling, tripling up. That's more than bond demand being low at this time, but I will get into that later on in the video. So now that we've gone over both QE and QT and you guys have a better understanding of both and how they affect the market, I want to talk now about the federal funds rate and how it affects the lending cycles that we have been experiencing over the past 20 years. When we have interest rates this low, it encourages lending to an extreme amount. If you look at the federal funds rate before the dot-com bubble, the 2001 crash, just think for a moment, okay? If you are trying to encourage lending with the civilization and the economy that you're controlling, right? How do you do it? You have low mortgage rates across the board because everyone is completely brainwashed into thinking that owning a home makes you rich and owning something, like an asset of that value, it makes you deemed wealthy. When in reality, it's just a gigantic debt vehicle. So let's go over the federal funds rate chart over the last 20 years so you can see effectively how they use stock market crashes and crises to lower the 10-year, which lowers the federal funds rate, which incentivizes lending and stimulates the economy through some type of money injection, which encourages people to buy these debt vehicles. And let me just take a little pivot to that. When we're talking about incentivizing lending and lowering rates, just look at the federal funds rate and the history of it right here, okay? Before the tech bubble 2001 crash, look at where interest rates were. 6.45% federal funds rate, okay? That's higher than it is now, right? And then what happens? The crash brings the 10-year down, right, which lowers interest rates. Then you get to here, you encourage lending. People buy homes, people buy homes, people buy homes, low mortgages. And then boom, the Fed starts raising rates again. All those 2008 mortgages that were ARM, adjustable rate loans instead of fixed over 30 years, those went up and people started defaulting on their homes. They were foreclosed, they had to declare bankruptcy, whatever. The banks own the homes. 2008 crash happens. Boom, we're back down here. And what happens here when the rates are low again? Incentivizes more lending. People buy homes. The rates go up. We get to this point where it might be a little more unsustainable and the housing market isn't growing as fast as it should. And then you get another crash. And then you get back down here. Rates are low again. Incentivize lending. People buy homes, and look where we are right now. Okay? So, hugely important. Remember that. You're told ever since you were a kid that you gotta grow up, do this, get married, and buy a home. It's been programmed into your mind that going that route is the route to go. But in reality, what a home really is, if you can't pay it off and you have to borrow against it to take out a mortgage loan, is a debt vehicle. So you are paying a ridiculous amount of interest over 30 years on your mortgage rate. And things didn't used to be like that. Like the savings and loan crisis that happened in the 80s, savings and loan companies, firms, institutions, they used to, before banks were doing it, they were the ones that would give out mortgages at low rates to encourage people to get new houses. And this happened after World War II. After World War II, all the money that was created to create planes and tanks and do whatever they had to do to stop the Germans, that money trickled into the economy. And that's why you see the 50s and 60s, huge housing boom, huge expansion. Everyone felt rich during that time. Everyone was making money, and buying a house was the number one way to do it. Houses appreciated like crazy. And then you get the stagflation of the 1970s, right? In which Volcker had to come in and raise interest rates to a mind-bending 21.5% it was, to curb and stop that inflation from happening. So you see like the writing on the wall, like over each decade, like what it led to. And we get to this point in 2008, and they start this thing called quantitative easing to pump more money into the market as aggressively as possible. Just think of it from a common sense standpoint. Like, you inject money into economy with lax political or government policies, something like quantitative easing, you inject all this money and pushes up the money supply, which drives inflation up, even though it does instill more lending and borrowing to lock these people into these debt vehicles. Inflation rises, so they have to raise interest rates, which hurt corporate earnings. Corporate earnings drive the S&P 500 and drive, higher interest rates, hinder borrowing, etc. It's a reverse effect. You have a stock market crash and you reset the cycle all over again. And that's the end of part 2. Part 3, we are going to talk about the debt ceiling being raised, and we are going to get into the period where QT, quantitative tightening, begins. The Fed begins reducing their balance sheet and how it affects the general market.